Welcome back to New Money, and if you just joined us, we're discussing investments. My guest is Craig Pfeiffer, and you'd like to email me, you can send your query to info@anchorcapital.co.za. Craig, before we went off, you were talking about interest rates. Which currency is likely? I mean, if interest rates get cut across the board, well, American interest rates, South African, is that likely to be good for the rand or good for the dollar?
I think it's all relative. So they're all cutting interest rates. It's probably the currency theoretically that should weaken the most is the one where the interest rates are cut the most. So your interest rates are lower, it's less attractive to go there, and you'd rather go somewhere else where there's a higher interest rate. So that would divert cash flows to another currency. So if the ECB went on a rate cutting spree and the US was a little slower to cut rates, you'd expect the US dollar to stay firm or even appreciate against the euro. So it's a bit of a lottery about who's going to do what and who's going to cut rates to a greater extent. I think the market has been looking for the dollar to weaken up a bit, given that it's been quite strong for some time. But I'd be a bit hesitant to call the demise of the dollar just yet. But as far as the rand goes, I think we've come from a place of being, extreme weakness. We have improved a bit, and my longer term expectation is still for the rand to depreciate over time. I still think we run a current account deficit. We're still running this fiscal deficit. Our inflation rate is still higher than those of our trading partners. So I think structurally the rand could still depreciate over the longer term, but we can still have these periods of extreme strength and weakness. I think though where we are now is probably we could stick around here for a little bit, around the 18 level. We've got the US. If we all cut rates in September, then we should still be on a par from where we were now. So I wouldn't expect that to have too much of an influence on the exchange rate.
Although, Craig, 0.25% in American interest rates, percentage-wise, will be a lot greater than 0.25% on South Africa's because of a higher rate of interest.
Correct. The one's at 5.25, and we're at 8.25. So, that's a fair comment.
Yeah. Okay, Craig, I'm going to get to some emails. Catherine in Germiston says, I'm a trustee of a pension fund and would like to know whether pension funds should be investing in hedge funds and even a small percentage in Bitcoin.
All right. Well, I think hedge funds for a start. There's no issue with hedge funds. You just need to look and see if that hedge fund is regulated or how you're accessing that hedge fund. Is it on a listed platform? Is it unlisted? Is it via a more diversified fund of hedge funds? But nothing wrong with hedge funds per se at all. They still offer you, good investment opportunities. So I'd look at that just in the overall scheme of your whole asset allocation of the portfolio. Bitcoin, I would still lump into the speculative category. Going long Bitcoin or whatever it is. If you wanted to play that theme, I think we would probably look to play it via what we would call the picks and shovels. Those people that supply the likes of wallets or the accounts that people use to play Bitcoin, like I'm not going to mention individual companies, but rather those companies or institutions that act as, let's say, as the banker, not as not Bitcoin or Ether, other Ethereum coin in particular. So I would still say those cryptocurrencies are still speculative, and I'd probably not put those into a pension fund.
Then Philip in Hillcrest says, what are the different methods for evaluating the performance of an investment portfolio? I mean, the comparisons presented by companies, they don't all have the same asset allocation. Therefore, is it easy? How easy is it to evaluate? How do you as a strategist evaluate, Craig?
Well, I think you've got to look at the underlying asset allocation. If you look at mutual funds or any kind of investment, you've got to sort of put it into some kind of a basket. Is it a balanced fund? Is it an aggressive equity-only portfolio or fund or collective investment scheme? If you look at our unit trust industry, all of the unit trusts get classified in a particular category, either large equity or medium equity or low equity or balanced funds. So those you can sort of compare apples with apples. I think just comparing, say, collective investment schemes with other maybe segregated portfolios, you should have a look at whether costs are included or not included in the calculation. And that way to see if you're comparing apples with apples. But overall, I mean, there's different techniques of measuring performance. There's time-weighted methodology or money-weighted methodology, and those can be quite technical. I think when we sit in front of clients, they want to really see, you gave me X, and now it's X plus 10 or X minus 10, explain that one for me. But yeah, there are nuances in, and just be sure what the underlying portfolio looks like that you're comparing against a benchmark or other portfolios.
And just to add to what Craig has said, just to say, I mean, if you've got a fund and you're comparing two funds, and both funds have got 70% in equities, one's got 35% of that 70 global, other one's only got 15, there's going to be a difference in performance, even though they're classified under the same fund. So you need to understand the mix of the fund within the thing. Betty in Krugersdorp says, my international investments have done exceptionally well over the last 5 years. Originally, my financial advisor estimated my portfolio would grow by 4% above inflation. With rand appreciation and performance, it's achieved double that. I do not need any money in the next few years. However, should I be taking some of the profits off the table? The question really must be, is the bull market just starting, or is it getting into dangerous levels? Craig?
I think there's more in the equity market over the next year or two. When I talk equity market, specifically thinking about the S&P 500, I think we're still going to see good earnings growth there for the rest of this year and into next year. On the principle that I talked about, the rand weakening again over time, unless you really need the funds, and the funds aren't needed now, I would stay invested. And just, even if there is a bit of a pullback in the shorter term, just ride through that cycle, but stay invested.
Obviously, I just need to add, if you're looking for growth, that is. If you're looking for income, there's no better place than South Africa, because you can look at all different things. But this is the next question from Mervyn in Kempton Park. He says, over half my portfolio is divided between preference shares and property funds. My need is income. Property stocks have certainly improved since COVID, but still way down in price. Preference shares, on the hand, have given good income, but have done nothing. What should I do? Craig, property funds and preference shares?
Yes, well, I think they're both doing what they say on the tin there. The listed property stocks, they were decimated after COVID. They've had, a bit of a re-rating more recently. They performed quite well last year. I think property companies themselves are still struggling on the office side, but they've generally re-engineered themselves into a better place. And I think going forward, you can still, over the longer term, expect modest growth with your income. You must remember that income, though, is taxable at your. Now I'm sounding like a financial advisor, but it's different income from the preference shares, which is a dividend. So the preference shares, you're not going to make, very much on the capital side. But you will get an extraordinarily good dividend, which will then just be subject to dividend withholding tax. So you just lop off 20% there, whereas the listed property, you're going to be taxed at your marginal tax rate.
Craig,
in essence, I would keep a mix of them as you have them.
Craig, what was the story about the companies buying back their preference shares? I mean, some of the companies have done that, but there's still a few, I think of Standard Bank and a few others. Is that likely still to happen?
Yeah, I think we've got Standard Bank, we've got ABSA left as well. The thing was really around the Basel agreements. The capital that banks have issued in terms of preference shares no longer count as qualifying capital. So essentially, the banks don't need to have that preference share capital any longer. And that's why some of the banks have bought it back. I would expect that some of the others of the banks would potentially buy theirs back as well. There's no real requirement for them to have those preference shares any longer. There was a 10-year window over which the capital was counted as qualifying capital, but it reduced now to zero. So that time has passed. So no need for the banks to still have them. One can't second guess the banks, but I would think that they might still buy theirs back in time.
And if they do, the others have all bought them back at par. So if you're sitting with a Standard Bank one, I think about somewhere around about 88, par's 100. So who knows? But we're not going to speculate on that. I'm going to sneak one more email in from Manfred and Centurion. He says, do fund managers commit their own capital alongside the client's funds? And how important is this?
Yeah, some do, and some don't. There's some institutions maybe have a requirement that the portfolio managers put some of their own capital into the fund, give them some skin in the game. It's probably not the mainstream, but if you as an investor are looking at those funds to invest in, if you can find a fund manager that's got enough confidence in themselves to invest in their own fund, and invest significantly, I think that's a positive sign. You really, if you've got your own skin in the game, you want to see that portfolio do well. So I would see it, more as a positive, largely a positive.
Well, although no one can predict in the short term what equities are going to do, what is certain is that there are many varied predictions. There will always be time when markets have had a good run and profit-taking, and any negative comments will create short-term downturns. I always emphasize that one cannot watch one's investment portfolios monthly or even yearly. The two asset classes that will result in long-term growth are property and equities. Everyone understands that when you buy a property, it's long-term. The same characteristics apply to equities, and yet many of us watch it on a regular basis. What you need to do is to ensure the following. Has your time frame of your investment strategy changed? Do you require any additional income? Have you drawn more from your investment that was originally anticipated? And if you have drawn more, how does it affect your future position? I'd like to thank Craig for joining me this evening, and it's important to note our program tonight is to provide information and should not be construed as advice. Next week's program, I'll deal with financial and retirement planning, and if you need to get hold of me, my details are on the screen. Thank you for watching, and good night.